There is a powerful, almost gravitational force in the world of finance, a siren song that whispers of revolution, of disruption, of the next big thing. It's the story of the garage startup that becomes a global titan, the visionary coder who changes the world from a dorm room. We are saturated with these narratives. They flicker across our screens, they dominate the headlines, and they fuel a frantic, almost desperate search for the company that will deliver a thousand-fold return overnight. This is the world of hype, of explosive growth, of technological miracles, and for 99% of investors, it is a graveyard of capital. It is a place where fortunes are promised, but life savings go to die, consumed by the fire of unpredictable innovation and cutthroat competition. But what if the entire premise is wrong? What if the greatest, most durable, and most certain path to building monumental wealth lies not in the glittering chaos of the new, but in the quiet, overlooked, and profoundly boring corners of the economy? This is the central secret, the genetic code of the investing philosophy that built the single greatest fortune of the modern era. It belongs to Warren Buffett, a man who became a living legend not by chasing rockets to Mars or decoding the human genome, but by investing in things like chewing gum, paint, bricks, and soda pop. He understood a truth so simple it seems almost insulting. The most powerful competitive advantages, the most predictable streams of cash, and the most reliable compounding machines are not found in industries that change at the speed of light, but in those that barely change at all. The lack of disruption, the absence of existential threats, the sheer, beautiful monotony of it all is not a weakness, it is the ultimate strength. It allows a truly great company to sit atop its industry, widening its lead, decade after decade, while its competitors in the more glamorous sectors are forced into a brutal, never-ending war for survival. This journey we are about to embark on is a radical re-engineering of your financial worldview. It is an act of deprogramming. We will strip away the layers of media-driven hype and Silicon Valley myth-making to reveal the bedrock principles of durable wealth creation. We will deconstruct Buffett's profound preference for the mundane, not as a quaint quirk, but as a calculated, razor-sharp strategy for risk management and superior returns. You will learn to see the world not through the eyes of a gambler looking for a lottery ticket, but through the eyes of a business owner looking to buy a piece of an unshakable enterprise. This is the blueprint for finding great stocks in boring industries, for understanding why. In the world of long-term investing, boring is not just good. Boring is beautifully, unimaginably profitable. Our first step in this deconstruction is to understand the foundational pillar upon which this entire philosophy rests, the power of predictability. This isn't just about finding a stable company. It's about finding a stable industry, an entire economic ecosystem where the fundamental rules of the game are so ingrained and slow to change that you can look a decade into the future and have a reasonably clear picture of what it will look like. It's the opposite of forecasting the future of artificial intelligence or quantum computing. It's about forecasting the future of people's desire to chew gum or sweeten their coffee. To truly grasp this, we must travel back to 1972, to a moment that would become a defining chapter in the Berkshire Hathaway saga, a story not of complex derivatives or leveraged buyouts, but of chocolate. The story begins not in Omaha but in California, with a family-owned business called See's Candies. See's was the quintessential boring business. Founded in 1921 by Mary See, it sold high-quality, old-fashioned chocolates and candies through its own chain of retail stores, primarily on the West Coast. The product hadn't fundamentally changed in 50 years. The recipes were classic, the black and white branding was iconic, and its customers were fiercely loyal, returning year after year, generation after generation, for their Valentine's Day hearts and Christmas brittles. It was a business built on tradition and simple pleasure, a universe away from the semiconductor wars and corporate raiding that defined the era. Warren Buffett and his partner Charlie Munger learned of the opportunity through a friend. The See family, descendants of the founder, were looking to sell. Buffett, ever the student of business, was intrigued. He and Munger flew out to meet with the family and dive into the numbers. What they found was a jewel. The business required very little capital to operate. It had a beloved brand, which gave it pricing power. It could raise its prices slightly each year to account for inflation, and its devoted customers wouldn't flinch. The business generated about $4 million a year in pre-tax earnings, and perhaps most importantly, it did so with only about $8 million in net tangible assets. This was a business that gushed cash relative to the capital tied up in it. The asking price was $30 million. Buffett, a strict disciple of Benjamin Graham's cigar butt approach at the time, which focused on buying mediocre businesses at dirt-cheap prices, initially balked. The numbers told him it was too expensive. $30 million for a business with only $8 million in tangible assets meant he would be paying a massive $22 million premium for intangible things: goodwill, brand reputation, customer loyalty. His analytical mind, trained to hunt for statistical bargains, screamed that this was a bad deal. He offered $25 million, and it was a firm offer. He was ready to walk away. This is where Charlie Munger stepped in and changed the course of Berkshire Hathaway forever. Munger saw what Buffett was missing. He understood that the intangible value, the brand, the loyalty, the predictability, was the most valuable asset of all. He argued forcefully that a wonderful business at a fair price is infinitely better than a fair business at a wonderful price. He told Buffett, "Warren, this is the kind of business we should be buying. Don't let a few $1 million get in the way." It was a pivotal moment. Buffett, to his credit, listened. He overcame his own ingrained biases, trusted his partner, and agreed to the $30 million price, although they eventually negotiated it down to a final purchase price of $25 million. What happened next is the stuff of investment legend and the perfect illustration of the power of predictability. See's Candies, the boring chocolate company, became Berkshire's compounding machine. Because the business was so simple and required so little innovation or major capital reinvestment, almost all the profit it generated could be taken out of the business each year and redeployed elsewhere. That $25 million investment has since generated, in aggregate, over $2 billion in pre-tax earnings for Berkshire Hathaway. That is not a typo. $2 billion. And all that cash was sent to Omaha for Warren Buffett to invest in other businesses. The boring chocolate company became the financial engine that funded the acquisition of other, larger enterprises. It required no genius to run, no technological breakthroughs to sustain, no all-night coding sessions to keep it relevant. All it had to do was keep making the same great chocolates it had been making for decades. The predictability of See's Candies was its superpower. Buffett knew in 1972 that in 1982, 1992, and 2002, people on the West Coast would still be buying See's chocolates for holidays and special occasions. The internet wouldn't change that. New fashions wouldn't change that. A recession might cause a slight dip, but the fundamental desire and the brand loyalty would remain intact. He couldn't have said the same thing about the leading manufacturer of 8-track tape players or mainframe computers. That certainty, that ability to see the long-term earnings power of the business with a high degree of confidence, is what allowed him to pay a price that initially seemed high. He wasn't buying a collection of assets. He was buying a predictable stream of future cash flows, a private economic royalty on a simple human pleasure. This anecdote is the foundational text for his shift in strategy and the cornerstone of his belief that the most lucrative hunting ground for an intelligent investor is the one everyone else finds too dull to explore. To truly understand why this strategy is so effective, we have to peel back the layers of our own minds. We must examine the underlying psychological principles that make Buffett's approach both so difficult for most people to emulate and so incredibly powerful. The human brain, for all its marvels, is a deeply flawed machine when it comes to long-term investing. It is a product of millennia of evolution on the savannah, not Wall Street. Our cognitive architecture is wired to detect immediate threats, to seek novelty, and to react quickly to a changing environment. These traits, which kept us alive in the face of predators and famines, become profound liabilities when managing a portfolio. The primary cognitive bias that Buffett's boring strategy overcomes is what psychologists call the availability heuristic. This is our tendency to overestimate the importance of information that is easily available to us. The news media, financial television, and social media are in a constant state of breathless excitement about what is new, what is disruptive, what is changing the world. We are bombarded with stories of tech IPOs, cryptocurrency millionaires, and visionary CEOs. Therefore, our brains naturally conclude that these are the most important and profitable areas in which to invest. The silent, steady performance of a company that makes wall-to-wall carpeting or distributes industrial lubricants doesn't make headlines. It is not readily available to our consciousness. As a result, we systematically underestimate its importance and its potential for wealth creation. Buffett's genius lies in his deliberate decision to invert this heuristic. He actively seeks out the information that is the stories that are not being told, precisely because he knows that's where the market is most likely to be inefficient and mispriced. This ties directly into another powerful mental flaw, the action bias. We feel a deep-seated need to do something, especially when faced with uncertainty or the perception that others are getting rich. Seeing a stock double in a month triggers a powerful fear of missing out, or FOMO, which is a modern manifestation of our ancient herd instincts. The brain screams, "Everyone else is running toward that fruit tree. If I don't run, I'll starve." In investing, this translates to chasing hot stocks, constantly tinkering with one's portfolio, and jumping from one trend to the next. Investing in a boring company is an act of profound inaction. You buy it, and then, for years, you do nothing. This feels unnatural. It feels passive. It feels like you're not participating in the great game. Buffett understands that in investing, activity is often the enemy of returns. The most profitable action is very often no action at all. His focus on predictable businesses is a structural defense against the itch to act. When you know what a business will likely be doing in 10 years, the daily noise of the market becomes irrelevant, and the urge to trade evaporates. Furthermore, this approach masterfully sidesteps the overconfidence bias, particularly the Dunning-Kruger effect, where people with low ability at a task overestimate their ability. The world of technology and high-growth industries is fantastically complex. Predicting the long-term winner in a field like cloud computing or gene editing requires a level of specialized knowledge that very few people, including professional investors, actually possess. Yet, many wade into these waters, armed with a few articles and a dose of misplaced confidence, believing they can pick the next Amazon. Buffett's focus on simple, boring businesses is an act of intellectual humility. By defining his circle of competence, he is admitting what he doesn't know. He knows he can't predict the future of semiconductors, but he is very confident he can predict the future of Coca-Cola. This isn't a sign of weakness. It is the ultimate sign of intellectual rigor. He avoids the areas where he is most likely to be overconfident and suffer a catastrophic loss. He plays the game where he knows he has an edge, and that edge is found in the simplicity and predictability of the mundane. Choosing boring is a conscious, disciplined choice to play a game you can win, rather than getting lured into a game of chance where the odds are stacked against you. So how do we translate this powerful psychological insight into a practical, repeatable process? How do we build a blueprint for finding these predictable, wealth-creating machines? This is where we move from theory to application, creating an applied mental model that you can use to filter the investment universe. Let's call it the Decade Bridge Framework. Its purpose is to force you to think like a long-term business owner and screen out the speculative noise. It consists of 4 distinct steps. Step 1 is what I call the industry stillness audit. Before you even look at a specific company, you must analyze the industry it operates in. The core question is, how much has the fundamental product or service in this industry changed in the last 20, 50, or even 100 years? Think about it. The chewing gum sold by Wrigley, a longtime Buffett holding, is fundamentally the same product it was in the 1920s. The paint sold by Benjamin Moore, another Berkshire company, still performs the same basic function, coloring and protecting a surface, that it did a century ago. The bricks made by Acme Brick are virtually identical to the ones made in your great-grandfather's time. Now, contrast that with telecommunications. In just 30 years, we've gone from dial-up modems and car phones the size of a brick to global high-speed wireless networks streaming 4K video to a supercomputer in your pocket. The rate of change is staggering. For your stillness audit, create a simple 1 to 10 scale. A 1 represents an industry in constant radical flux like artificial intelligence hardware. A 10 represents an industry in near total stasis, like salt production or funeral services. Your primary hunting ground for great, predictable businesses should be in the 7 to 10 range. This single filter will eliminate over 90% of the market and save you from countless potential mistakes. Step 2 is the future visibility test. This is a qualitative, imaginative exercise. Pick a company that passed the stillness audit. Now, close your eyes and try to imagine its business and its competitive landscape 10 years from now. Be specific. What will its primary product be? Who will its main customers be? Who will its biggest competitors be? What is the single biggest threat that could derail it? If you're analyzing a company like Hershey's, the chocolate and candy maker, this exercise is relatively easy. In 10 years, they will almost certainly still be selling chocolate bars to consumers through grocery and convenience stores. Their biggest competitor will likely still be Mars. The biggest threat might be a long-term shift in consumer health preferences, but the core business is highly visible. Now try to do the same for a leading cybersecurity firm. What will the primary cyber threats be in a decade? What new technologies will have emerged? Will their current software be obsolete? Who will their competitors be? The picture becomes incredibly blurry, almost impossible to paint with any confidence. If you cannot describe the business and its industry with a high degree of certainty a decade out, you do not have the predictability required for a true Buffett-style investment. This test protects your portfolio strategy from the unknowable. Step 3 is the low CapEx cash flow analysis. This is where we get into the financial statements, the quantitative proof of a boring business's superiority. You need to look at the statement of cash flows for the last 10 years. Specifically, you are looking for the relationship between net income and capital expenditures, or CapEx. Capital expenditures are the funds a company uses to acquire, upgrade, and maintain physical assets like property, buildings, and equipment. In a fast-changing, competitive industry, CapEx is enormous. A semiconductor company has to spend billions every few years on new fabrication plants just to keep up. An airline has to constantly buy new, more efficient planes. A boring business, by contrast, often has very low CapEx requirements relative to its earnings. See's Candies didn't need to reinvent its kitchens every year. A railroad needs to maintain its tracks, but it doesn't need to reinvent the concept of a railroad. You want to find businesses where a large portion of the net income consistently converts into free cash flow, the cash left over after all expenses and capital expenditures are paid. This free cash flow is the golden goose. It's the money that can be used to pay dividends, buy back stock, or, in Berkshire's case, be sent to the parent company to acquire more businesses. A high free cash flow conversion rate is a financial signature of a wonderful, predictable, boring business. The fourth and final step is the unsexy brand power litmus test. Many boring industries are dominated by one or two companies with incredibly powerful, albeit unglamorous, brands. This brand power creates a moat around the business. Think of Sherwin-Williams in paint, Moody's in credit ratings, or Waste Management in trash collection. These aren't exciting brands like Tesla or Apple, but for their specific customers, they represent trust, reliability, and quality. The test is this. If a new competitor entered the market with a similar product at a 20% lower price, would the dominant company's customers switch? For many of these boring titans, the answer is no. A contractor isn't going to risk his reputation on a cheap, unproven paint. A municipal bond issuer isn't going to get a rating from a no-name agency. A city government isn't going to entrust its sanitation to an unreliable startup to save a few bucks. This brand loyalty, this built-in customer inertia, is a source of immense pricing power and predictability. It ensures that the company can protect its margins and market share for decades to come, creating a stable platform for long-term compounding and building wealth. This framework, the Decade Bridge, is your systematic guide to emulating Buffett's core logic and finding those hidden gems in the parts of the market everyone else finds too dull to even consider. To fully appreciate the wisdom of this path, we must dedicate ourselves to studying its opposite. We must explore the antithesis, the well-trodden path of the 99%, the road paved with excitement, hype, and ultimately, financial ruin. This is the world of chasing narrative over numbers, of confusing a great story with a great investment. It is the magnetic pull of the new paradigm, a dangerous phrase that has vaporized more capital than all the market crashes in history combined. The most vivid classroom for this lesson remains the turn of the millennium, the spectacular rise and fall of the dot-com bubble. Between 1995 and early 2000, the world was gripped by a collective euphoria. The internet was not just a new technology, it was hailed as a fundamental rewiring of the global economy. The old rules of business, it was said, no longer applied. Profits didn't matter. Cash flow was an archaic concept. All that mattered was growth in eyeballs, in website clicks, in market share, no matter the cost. A company's value was not tied to its ability to generate cash, but to the perceived size of the, quote, total addressable market it might one day capture. This was a perfect storm for cognitive biases to run rampant. The availability heuristic was in overdrive. Every news channel, every magazine cover, screamed stories of 20-something tech founders becoming billionaires overnight. The action bias was a pandemic. Ordinary people, from doctors to teachers, quit their jobs to become day traders, convinced that clicking a mouse was a substitute for sound investment research. Consider the cautionary tale of Pets.com. The company had a charming sock puppet mascot, a catchy slogan, and a massive advertising budget, including a Super Bowl commercial. Its business model was simple: sell pet supplies online. It went public in February of 2000 and raised $82 million. Investors clamored to buy the stock, not because the company was profitable, it was losing staggering amounts of money, but because it was an internet company in a huge market. People love their pets, the logic went, and the internet is the future, so Pets.com must be a great investment. But the basic economics were a disaster. The company was spending a fortune on advertising to acquire customers who would then buy a 50-pound bag of dog food. The cost of shipping that heavy, low-margin item often exceeded the profit on the sale. The business was structurally, hopelessly unprofitable. Yet, for a brief moment, the market valued it in the hundreds of millions of dollars. Just 9 months after its IPO, Pets.com was bankrupt. Its stock was worthless. The sock puppet became a symbol of an entire era's folly. Or take Webvan, another poster child of the bubble. The company had an even more ambitious vision: deliver groceries to people's homes. They built massive, state-of-the-art automated warehouses, spending over $1 billion of investor capital before they had even proven the business model could work at scale. The logistics were a nightmare. The costs were astronomical. They were trying to solve an incredibly complex problem, the last mile of delivery, with brute force and borrowed money. The narrative was seductive. It's the grocery store of the future. Investors, caught in the mania, poured money in. They ignored the colossal cash burn. They ignored the lack of any clear path to profitability. They were buying the story. Webvan filed for bankruptcy in 2001, wiping out billions in investment and becoming one of the most spectacular failures of the era. While the world was intoxicated with these futuristic money-losing ventures, what was Warren Buffett doing? He was being publicly ridiculed. He was called a dinosaur, a man who, to quote, didn't get it. Barron's ran a cover story in 1999 titled, "What's Wrong, Warren?" His refusal to invest in dot-com stocks was seen as a sign that he had lost his touch. Berkshire Hathaway's stock was underperforming the soaring NASDAQ. But Buffett was simply adhering to his principles. He was running these companies through his mental models. The industry stillness audit? The tech sector was a 1 on the scale, pure chaos. The future visibility test? Impossible. Who would be the winners in 5 or 10 years? Nobody knew. The low capex cash flow analysis? These companies had no cash flow. They had cash burn. They were incinerators of capital, not generators of it. The path of the 99% was to suspend all critical thinking and buy the narrative. Buffett's path was to stick to his discipline, to his circle of competence, even when it was deeply unpopular. When the bubble burst in March of 2000, the consequences were devastating. The Nasdaq index, heavy with tech stocks, lost nearly 80% of its value over the next 2 years. Trillions of dollars in paper wealth evaporated. The day traders went back to their old jobs, their dreams of easy financial freedom shattered. The portfolios of those who chased the hype were decimated. And Berkshire Hathaway? It sailed through the storm almost untouched. Its collection of boring businesses, insurance, furniture, candy, newspapers, kept on generating predictable profits. The crash was a brutal, multi-trillion-dollar lesson in the danger of ignoring the timeless principles of business in favor of a seductive story. It stands as the ultimate antithesis, a permanent monument to the fact that excitement and investing are, more often than not, mortal enemies. The path of the 99% is a crowded road to a cliff's edge. The path of the intelligent investor is a lonely, often boring, but ultimately safe and prosperous road home. This brings us to the final, most crucial piece of the puzzle, the direct financial connection. How does this philosophical preference for the predictable and the boring translate into tangible, quantifiable financial advantage? It all comes down to the most fundamental equation in finance, the principle that the value of any asset, be it a stock, a bond, or a piece of real estate, is the present value of the cash it will generate over its lifetime. This concept, known as discounted cash flow or DCF analysis, is the bedrock of all serious valuation. The formula itself is simple, but its implications are profound. Imagine you have 2 businesses. Business A is Boring Bricks Inc. It manufactures and sells bricks, a product that hasn't changed in 1,000 years. Its revenues grow at a slow and steady 3% per year, just a bit above inflation. Its profit margins are stable, and its cash flows are as reliable as the sunrise. Business B is Quantum Leap AI, a cutting-edge startup developing a revolutionary new artificial intelligence platform. It has the potential for explosive 50% annual growth. Its story is exciting, its technology is groundbreaking, and it's all over the news. The typical investor, driven by the psychological biases we've discussed, is immediately drawn to Quantum Leap AI. They see the massive potential upside, the chance to get in on the ground floor of the next big thing. They might scribble a quick calculation based on its potential future size and decide it's a bargain. But the intelligent investor, the one using Buffett's lens, sees a very different picture. They understand that the DCF equation has 2 key variables: the future cash flows themselves and the discount rate you apply to them. The discount rate is essentially a measure of risk or uncertainty. The more uncertain the future cash flows, the higher the discount rate you must use to bring them back to their present value. A higher discount rate acts as a penalty for uncertainty, dramatically reducing the calculated value of the business today. For Boring Bricks Inc., forecasting the future cash flows is a relatively straightforward exercise. You can look at the last 20 years of housing starts, commercial construction, and pricing, and project the next 10 years with a reasonably high degree of confidence. Because this forecast is so reliable, you can use a low discount rate, say 7%. The certainty of the cash flows means you don't need a large margin of safety in your discount rate. Now, try to do the same for Quantum Leap AI. What will its cash flows be next year? In 5 years? In 10 years? The range of possible outcomes is immense. It could be worth trillions, or it could be bankrupt. Will a competitor develop a better technology? Will governments regulate its platform? Will they ever even achieve profitability? The uncertainty is off the charts. To account for this massive risk, a rational investor would have to apply a very high discount rate, perhaps 25 or 30%, or even higher. Here's where the financial magic happens. Even though Quantum Leap AI has a much higher potential trend growth rate, the massive discount rate applied to its speculative future cash flows can often result in an asterisk lower trend than that of the slow-growing but highly predictable brick company. The certainty of the cash flow is a more powerful driver of value than the sheer magnitude of its potential growth. On a balance sheet, this manifests as stability. Boring bricks will have consistent inventory levels, predictable accounts receivable, and manageable debt. Quantum Leap AI's balance sheet will be a whirlwind of cash burn, stock options, and intangible assets that could be worthless tomorrow. In a portfolio, this translates directly to lower volatility and better risk-adjusted returns. The stock of boring bricks will chug along, perhaps not doubling in a year, but providing a steady, compounding return with minimal drama. The stock of Quantum Leap AI will be a wild roller coaster capable of spectacular gains, but also of catastrophic, permanent losses of capital. This is the hidden financial engine of Buffett's strategy. He is a master of risk management. By focusing on industries where the future is a clearer, less blurry picture, he dramatically reduces the probability of a zero. A company like See's Candies or Coca-Cola has a near zero chance of being technologically obsolete in a decade. The same cannot be said for even the most dominant tech company of today. This focus on predictability allows him to invest large sums of capital with confidence, to hold for the long term without losing sleep, and to allow the miracle of compounding to work its magic on a stable base. The direct financial connection is this: predictability lowers the discount rate, which increases the reliable present value of a business and dramatically reduces the risk of permanent capital loss, which is the single most important factor in achieving long-term financial freedom. We have reached the second pillar of this philosophy, a concept that flows directly from the power of predictability, the indestructible economic moat. If predictability is about finding a stable castle, the economic moat is about the width and depth of the ditch surrounding it, filled with crocodiles and archers, protecting it from invaders. In business, invaders are competitors. A great business must have a durable, long-lasting competitive advantage that prevents rivals from eating away its market share and eroding its profitability. And here again, we find that the most boring industries often harbor the widest, most impenetrable moats, fortifications built over decades that are nearly impossible for a newcomer to breach. To understand this in its purest form, we must turn our attention to what is perhaps Buffett's most famous and successful investment, a company whose product is little more than colored, sweetened water, the Coca-Cola Company. The story of Berkshire's investment begins in the fall of 1988. The stock market was still reeling from the crash of October 1987, known as Black Monday. Fear was palpable. Investors were terrified of another downturn, and many were fleeing the market. Buffett, as is his habit, was doing the opposite. He was on the hunt for bargains for wonderful businesses that had been put on sale due to irrational fear. He turned his analytical gaze to Coca-Cola. On the surface, Coca-Cola was the epitome of a boring business. Its core product, Coke, had been invented over a century earlier in 1886. The formula was a closely guarded secret, but the business model was brutally simple: create a concentrate, sell it to a global network of bottlers, and spend heavily on advertising to ensure that when someone, anywhere in the world, thought of a refreshing drink, the first image that popped into their head was a red can with a white swoosh. There was no complex technology, no PhDs in white lab coats driving innovation. It was a business of repetition, consistency, and masterful branding. Buffett began his research. He read the annual reports going back decades. He talked to competitors, to bottlers, to supermarket owners. He even, in his classic folksy way, conducted his own field research by observing people's purchasing habits. He saw something that the market in its post-crash panic was overlooking. He saw a business with an economic moat that was less like a ditch and more like a vast ocean. The moat wasn't based on a patent or a technological edge which can expire or be leapfrogged. It was based on something far more powerful and durable: the human mind. For 100 years, Coca-Cola had spent billions of dollars, an almost unimaginable sum, to purchase a tiny piece of real estate in the brain of nearly every person on the planet. The brand was synonymous with happiness, with refreshment, with shared moments. A thirsty person on a hot day in Mumbai or Mexico City or Memphis didn't just want a carbonated beverage, they wanted a Coke. This mental dominance, this share of mind, was an almost insurmountable barrier to entry. How could a new company, even with a better-tasting product and a lower price, ever hope to dislodge a century of accumulated brand equity? It would take tens of billions of dollars and many decades, with no guarantee of success. Moreover, the company's business model was a work of genius. By outsourcing the capital-intensive bottling and distribution to a network of partners, Coca-Cola itself was an incredibly capital-light business. It was effectively a royalty on global thirst. It sold syrup, a high-margin product, and let others deal with the trucks, factories, and labor. This meant that, like See's candies, it generated enormous amounts of free cash flow that could be returned to shareholders. Between the summer and fall of 1988, while others were paralyzed by fear, Buffett directed Berkshire Hathaway to begin accumulating a massive position in Coca-Cola stock. Over a period of several months, he invested over $1 billion, buying up more than 6% of the entire company. At the time, it was the largest single investment Berkshire had ever made. The market was stunned. Some thought he was being too conservative, buying an old, slow-growing company. Others thought he was overpaying. But Buffett saw the value of the moat. He knew he wasn't just buying a company that sold soda. He was buying a piece of one of the most durable business franchises on earth. The results speak for themselves. The $1 billion investment has grown more than tenfold, not including the billions upon billions of dollars in dividends Berkshire has received over the past 3 decades. That single decision, rooted in an understanding of a boring product's indestructible moat, has created more wealth for his shareholders than 1,000 speculative tech bets ever could have. The Coca-Cola story is the ultimate lesson in the power of a non-technological, brand-based moat. It demonstrates that the most valuable competitive advantages are often the ones you can't see on a balance sheet, the ones that exist in the collective consciousness of humanity. They are slow to build and even slower to erode, making them the perfect foundation for a long-term compounding investment portfolio. The psychological principle underpinning the power of the economic moat is deeply rooted in our preference for cognitive ease and our aversion to risk. We are, at our core, creatures of habit. Our brains are energy-intensive organs, and they have evolved to create mental shortcuts or heuristics to conserve cognitive resources. Brand loyalty is one of the most powerful of these shortcuts. When you are standing in a supermarket aisle faced with dozens of choices for ketchup, your brain doesn't want to conduct a detailed analysis of price, ingredients, and company history for each bottle. It seeks the path of least resistance. It recognizes the familiar Heinz label, recalls a lifetime of positive associations, and makes the purchase decision in a fraction of a second. This is called the familiarity heuristic. Companies with strong moats, particularly brand-based moats like Coca-Cola, Heinz, or Gillette, are masters at exploiting this. They spend decades and fortunes building a consistent, reliable presence in our lives, creating a powerful sense of familiarity and trust. This trust reduces the perceived risk of a purchase. Buying the familiar brand feels safe. Trying a new, unknown brand feels risky. What if it's not as good? What if it's a waste of money? This loss aversion, our tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain, makes us hesitant to switch from a trusted product, even if a competitor offers a lower price. The potential loss of quality and satisfaction looms larger than the potential gain of a few saved cents. Another type of moat common in boring industries is based on high switching costs. This doesn't always mean a financial cost. It can also be a cost in time, effort, and retraining. Think of a company that provides payroll software to small businesses, like Paychex or ADP. Their product isn't exciting, but once a company has all its employee data entered, has its staff trained on the system, and has integrated it with its accounting, the thought of switching to a new provider is a nightmare. The process would be disruptive, time-consuming, and fraught with the risk of error. Even if a competitor offers a slightly better product at a lower price, the switching costs are so high that the customer remains locked in. This creates an incredibly sticky and predictable revenue stream, a powerful moat that has nothing to do with flashy technology. Then there is the network effect, a moat that becomes stronger as more people use a service. This is often associated with tech companies like Facebook or Visa, but it also applies to boring industries. Consider the railroads, one of Buffett's largest investments through BNSF Railway. A railroad's value is derived from the breadth of its network. A new company can't just lay a few miles of track and compete. To be useful, a railroad must connect major cities, ports, and industrial centers across the country. The sheer scale and cost of replicating BNSF's network is prohibitive, creating a nearly unbreachable moat. A customer shipping goods from Los Angeles to Chicago wants the most efficient, direct route, which the dominant network provides. The more cities the network connects, the more valuable it becomes to every customer, creating a virtuous cycle. Buffett's focus on these types of moats is a conscious strategy to avoid competing on the two most treacherous battlegrounds in business: price and features. A business that competes solely on price is in a race to the bottom, constantly sacrificing its profit margins. A business that competes on features is in a never-ending arms race, forced to spend heavily on research and development just to stay relevant. But a business with a moat, built on a brand, on high switching costs, or on a network effect, can often command premium pricing and doesn't need to constantly reinvent itself. It allows the business to earn high returns on capital for decades. Psychologically, it allows the investor to sleep well at night, knowing that the castle they own is protected not by a fleeting technological edge, but by the deep, enduring, and often irrational quirks of human behavior. How can you, as an investor, learn to identify these powerful economic moats? You need a systematic blueprint, a way to move beyond just recognizing a famous brand and truly diagnosing the structural advantages of a business. Let's call this the moat assessment matrix. It helps you score a company's defenses across 4 key dimensions. The first dimension is intangible assets. This is where brands, patents, and regulatory licenses live. To assess a brand moat, you must answer one simple question. Does the brand allow the company to charge a premium price for a product that is otherwise a commodity? For example, can Coca-Cola charge more for its brown sugar water than a generic store brand? Absolutely. Can Tiffany & Company charge a massive premium for a diamond ring in a little blue box? Without a doubt. This is the sign of a true brand moat. For patents, the key is their longevity and breadth. For regulatory licenses, think of credit rating agencies like Moody's or waste disposal companies that need permits to operate landfills. The question is how difficult it is for a new competitor to get government approval. A high score in this quadrant means the company has a powerful, non-physical barrier protecting its profits. The second dimension of the matrix is switching costs. As we discussed, this is the pain, expense, and hassle a customer would have to endure to switch to a competitor. To analyze this, you must put yourself in the customer's shoes. If your entire hospital's surgical team is trained on Intuitive Surgical's Da Vinci robotic system, how easy is it to switch to a competing system? The cost of retraining hundreds of surgeons and staff would be astronomical. If your entire company's design and engineering workflow is built around Autodesk software, switching to a new platform would grind your operations to a halt for months. Map out the entire process a customer would have to go through to leave. The more steps, the more departments involved, the more data to migrate, the wider the switching cost moat. The third dimension is the network effect. The key question here is, Does the value of the product or service increase for each individual user as the total number of users grows? The classic examples are credit cards like American Express or Visa. The more merchants that accept Amex, the more valuable it is to cardholders. The more cardholders who carry Amex, the more essential it is for merchants to accept it. This self-reinforcing loop is incredibly powerful. Look for businesses where the users create value for each other. This could be a railroad, a pipeline, or even a dominant industrial parts distributor whose vast inventory and network of locations makes it the one-stop shop for every mechanic in the country. The bigger it gets, the harder it is for anyone else to compete. The fourth and final dimension is cost advantages. This is the ability of a company to produce a product or service at a lower cost than its rivals, allowing it to either undercut them on price or earn higher profit margins. There are two main sources of cost advantages. The first is process. Does the company have a unique proprietary way of doing things that is more efficient? Think of the legendary Toyota production system. The second, and more common in boring industries, is scale. Because of its sheer size, can the company negotiate better prices from suppliers? Can it spread its fixed costs, like advertising and logistics, over a larger volume of sales? Walmart is the classic example. Its massive purchasing volume allows it to demand rock-bottom prices from its suppliers, a benefit it passes on to consumers, creating a virtuous cycle of high volume and low costs that smaller retailers simply cannot match. A company like Geico in insurance, owned by Berkshire, achieves a scale advantage in advertising, allowing it to saturate the airwaves more efficiently than its smaller rivals. By systematically analyzing a company through this four-quadrant matrix, intangible assets, switching costs, network effects, and cost advantages, you can move from a vague feeling about a company to a concrete diagnosis of its competitive position. The greatest businesses, the truly indestructible ones, often have multiple moats. Coca-Cola has a massive brand moat and a cost advantage from its global scale. A railroad has a network effect and a cost advantage. This blueprint provides a structured way to execute your investment research, ensuring that you are not just buying a good company, but a truly fortified economic castle capable of compounding your wealth for decades. Now let's once again journey to the land of the antithesis, to witness the graveyard of companies that ignored the importance of a durable moat. This is the world of fleeting advantages, of hyper-competition, and of industries where today's king is tomorrow's forgotten casualty. The landscape is littered with the ghosts of businesses that were once dominant, once thought invincible, but whose moats proved to be nothing more than shallow puddles. Consider the tragic story of Nokia. In the mid-2000s, Nokia was not just a company, it was a global behemoth. Its brand was iconic. It sold hundreds of millions of mobile phones every year. Its market share was colossal, approaching 40% globally. To many, it seemed to have an unbreachable moat built on its brand, its manufacturing scale, and its sophisticated supply chain management. If you had applied the moat assessment matrix back then, it would have scored highly. It had a powerful brand and significant cost advantages from its scale. It seemed like a perfect boring-ish tech investment, a dominant player in a maturing hardware market. But there was a fatal flaw in its moat. It was built on a technological foundation that was about to be rendered obsolete. The moat was based on being the best at making feature phones, devices for calling, texting, and playing simple games. Their entire corporate structure, their R&D, their very identity, was wrapped up in this paradigm. Then, in 2007, Apple introduced the iPhone. It wasn't just a better phone, it was a fundamentally different product. It was a powerful pocket-sized computer with a revolutionary touchscreen interface and a thriving ecosystem of third-party applications. Google quickly followed with the Android operating system, creating a two-pronged assault on Nokia's empire. Nokia's seemingly wide moat evaporated almost overnight. Its brand, once a symbol of innovation, suddenly looked old and clunky. Its scale advantage in manufacturing feature phones became a liability. a massive infrastructure geared toward producing a product nobody wanted anymore. The competitive battleground shifted from hardware efficiency to software ecosystems and user experience, an area where Nokia was woefully behind. The company was too slow to react, trapped by its own past success, a phenomenon known as the incumbent's dilemma. Within a few short years, its market share collapsed. Its profits vanished. The once mighty giant was forced to sell its handset business to Microsoft in a fire sale, a move that ended in a multi-billion-dollar write-off. The story of Nokia is a terrifying lesson. A moat built on a specific technology, no matter how dominant it seems, is always at risk of being drained by the next wave of innovation. This is precisely the kind of unpredictable, high-risk environment that Buffett's philosophy is designed to avoid. Another classic example is the brutal, moatless world of the airline industry, a sector Buffett has famously described as a death trap for investors. For decades, investors have been lured in by the apparent simplicity of the business: buy planes, sell tickets, fly people around. But the industry structure is fundamentally broken from a moat perspective. The barriers to entry are relatively low. A new company can lease a few planes and start flying a profitable route. The brand loyalty is almost non-existent. Most travelers will choose an airline based on price and schedule, not because they have a deep emotional connection to the brand. The switching costs are zero. You can fly United one day and Delta the next with no penalty. The product is a commodity. A seat in economy on one airline is virtually indistinguishable from a seat on another. This lack of any durable competitive advantage leads to suicidal, price-based competition. When a new low-cost carrier enters a market, the legacy airlines are forced to match its fares, crushing the profit margins for everyone. The industry is also incredibly capital-intensive, requiring constant, massive investments in new aircraft, and is highly susceptible to external shocks like fuel price spikes, economic recessions, and global pandemics. The result is an industry that, over its entire history, has collectively destroyed more capital than it has created. Despite its critical role in the global economy, it has been a terrible place for long-term investors, precisely because no company has ever been able to build a sustainable, wide moat. It represents the ultimate antithesis to a business like See's Candies or Coca-Cola, a constant, brutal and profitless war of attrition. The 99% are drawn to the familiar names and the essential nature of air travel, but they fail to see the catastrophic industry structure that lies beneath. The financial impact of owning a business with a wide economic moat is one of the most powerful forces in wealth creation. It is the secret ingredient that transforms a good company into a great, long-term compounding machine. Its effects are visible across the financial statements and are directly responsible for superior portfolio performance over time. The key concept to understand is return on invested capital, or ROIC. This metric measures how efficiently a company is using its capital, both debt and equity, to generate profits. A company in a highly competitive, moatless industry might have to spend $1 of capital to build a new factory just to earn an extra 5 cents of profit each year, a paltry 5% ROIC. This is a treadmill business. It has to keep spending enormous amounts of money just to stand still. Now, consider a company with a powerful moat, like Moody's, the credit rating agency. Because of its brand and the regulatory hurdles that protect it, an intangible asset moat, Moody's can generate massive profits with very little incremental capital investment. Its ROIC is consistently above 40 or 50%. It's like having a machine that takes in $1 and spits out 50 cents in profit every single year. This high return on capital is the fuel for compounding. A business that earns high returns on the capital it reinvests back into its own operations will see its intrinsic value grow at a much faster rate. But the true magic happens with mature, moated businesses that generate more cash than they can intelligently reinvest in their own operations. This is the gusher phenomenon we saw with See's Candies. That excess cash, protected by the moat from being whittled away by competition, can then be returned to shareholders in the form of dividends and stock buybacks. A dividend provides a direct cash return to the investor. A stock buyback, when done at a reasonable price, reduces the number of shares outstanding, making each remaining share more valuable and increasing its claim on the company's future earnings. Let's put this into a tangible portfolio example. Imagine you invest $10,000 in two companies. Company X is in a tough, competitive industry and earns a 6% return on its capital. Company Y has a wide moat and consistently earns a 20% return on its capital. Both companies retain half of their earnings to reinvest for growth and pay out the other half as a dividend. After 20 years, your investment in Company X, the low-return business, might have grown to $30,000 or $40,000, a respectable but not life-changing return. Your investment in Company Y, the high-return moated business, could be worth over $200,000. The difference is staggering, and it's driven entirely by the company's ability to sustainably earn high returns on its capital, an ability granted and protected by its economic moat. On the balance sheet, a wide moat creates a fortress of financial strength. Because the company generates so much cash and faces less competitive pressure, it can operate with much less debt. This reduces financial risk and makes the company more resilient during economic downturns. While its moatless competitors are struggling to make interest payments, the moated company can go on the offensive, buying up distressed assets or gaining market share. In a stock portfolio, this translates to both higher returns and lower risk. The stocks of wide moat companies tend to be less volatile. Their earnings are more predictable, which gives investors confidence and prevents the wild price swings associated with more speculative stocks. Over a long period, this combination of higher returns and lower volatility is the holy grail of investing. It is how you build durable generational wealth. The moat is not just a defensive tool, it is the single most powerful offensive weapon for long-term financial success. It is the structural guarantee that the compounding machine will be allowed to run, uninterrupted, for decades.